in the desolate, gray shipyards of South Korea's Jeoji Island and Japan's technical hubs, a silent tragedy of capital is unfolding. 6 Arc7 class ice-breaking LNG tankers, miracles of maritime engineering, each costing nearly $500 million, sit idle. They are the most expensive commercial vessels ever constructed, intended to be the crown jewels of Russia's Arctic expansion. For the U.S. Treasury and Western strategists, these ships are frozen assets, a $3 billion hostage in a geopolitical war of nerves. However, while the world focuses on these stationary hulls, a far more volatile signal is flashing on terminal screens in London, New York, and Hong Kong. As of early 2026, silver has shattered the $80 per ounce mark, a staggering surge that has caught the retail crowd and institutional shorts completely off guard. To the uninitiated, these two events, stranded ships in the Arctic and a silver squeeze in the futures market, seem worlds apart. But as a hedge fund manager looking at the macro grid, I can tell you, they are part of the same circuit. The Arctic is no longer just an energy province. It has become the vault of the North, the source of the world's most critical minerals, and the laboratory for a post-dollar financial order. Today, we are decoding how the blockade of $3 billion in shipping assets became the catalyst for a commodity-backed revolution that is pulling the rug out from under the Western financial system. The conflict on the Guidan Peninsula has evolved from a simple trade dispute into a full-scale maritime hot zone. The West's strategy was predicated on technological denial, by blocking the delivery of specialized tankers and prohibiting the export of liquefaction technology. The G7 believed they could turn Russia's Arctic LNG-2 project into a stranded asset. The siege of capital, Hanwha Ocean and Mitsui Oesk are caught in a legal limbo. They have built ships they cannot deliver, for a client they cannot charge, and for a route that only that client uses. This $3 billion in trapped capital is a gaping wound in the balance sheets of these maritime giants. For a time, it seemed the sanctions were working. Production at Arctic LNG-2 reportedly halted in late 2024 as storage reached capacity, the countermove. But Moscow did not play by the rules of the 20th century playbook. In late 2025, the Alexei Kosygin, the first domestically produced Arc7 carrier from Russia's Zvezda shipyard, began its sea trials. This vessel isn't just a ship, it's a middle finger to the G7. It was built using a hybrid of reverse-engineered Western tech and Chinese propulsion systems, proving that the technological blockade has a shelf life, the kinetic turn. The tension reached a breaking point in January 2026. U.S. naval and Coast Guard forces intercepted the Marinara in the North Atlantic and the Sophia in the Caribbean. These vessels, operating under the Shadow Fleet flag, were moving sanctioned energy and minerals. This marks a historic transition. The West has moved from financial sanctions to kinetic interdiction. When you start boarding ships in international waters, you are no longer managing a market, you are managing a war. Why silver is the strategic metal of the Arctic? To understand the price surge to $80, we must look at the industrial reality of the Arctic. Silver is the secret ingredient of the Northern Sea Route, NSR. In the extreme sub-zero temperatures of the Siberian coast, conventional electronics fail. Silver, with its unmatched thermal and electrical conductivity, is essential for the high-end sensors, GPS arrays, and specialized propulsion systems required for ice-breaking tankers. Furthermore, the Arctic is the world's next major source of silver and cobalt. Russia is consolidating its position as the fourth largest holder of these critical minerals. By pivoting the NSR into a trans-Arctic transport corridor, Moscow is now bypassing the Western-controlled Suez Canal to deliver these raw materials directly into the manufacturing heart of China. The silver squeeze isn't just a speculative bubble. It is a supply chain panic as the West realizes that the vault of the North is being locked from the inside. The logistics of the Shadow Fleet. The Shadow Fleet has matured. In 2025, over 100 sanctioned vessels traversed the NSR. This is no longer a collection of rust buckets, as described by the mainstream media. It is a sophisticated parallel logistics system, AI's obfuscation. These ships use advanced spoofing technology to project fake locations, allowing them to load gas and minerals while appearing to be in the Mediterranean. Non-dollar insurance. These vessels are insured by state-backed consortiums in Russia and China, rendering the Western price cap and insurance bans irrelevant. The icebreaker gap. Russia maintains over 50 icebreakers, while the US operates only 2 aging heavy vessels. In the Arctic, sovereignty belongs to whoever can move through the ice. Currently, that is not the United States. The seizure of the Marinara was a demonstration of financial hegemony, but it may have been a Pyrrhic victory. Every time the US uses the dollar-based maritime order to seize physical assets, it triggers a bank run at the nation-state level. Flight to hard assets. Central banks across the global south are watching. Their response: a massive diversification away from US treasuries and into physical commodities. This is the fundamental driver behind the $80 silver and the gold rallies of 2026. If your dollar-denominated assets can be seized on a whim, you don't own them. You're just renting them until the landlord changes his mind. The BRICS unit. We are now seeing the pilot launch of the BRICS unit. This is not a common currency like the euro, but a digital trade settlement mechanism. Crucially, the unit is proposed to be backed 40% by a basket of gold and silver, and 60% by the currencies of the member states. The Arctic LNG and mineral trade is the real-world laboratory for this system. Contracts are being settled in yuan, dirhams, and rubles, completely bypassing the SWIFT messaging system. Peru, for the first time in 80 years, a major global trade route is being operated entirely outside the reach of the New York banking system. Perhaps the most cynical part of this 2026 landscape is the role of Europe. Publicly, Brussels condemns Russian aggression and supports the blockade. Privately, the data tells a different story. In 2025, the EU actually increased its intake of Russian LNG from the Yamal project to over 76% of total exports. The irony is thick. While the US Navy seizes Russian-flagged tankers, European ports in Belgium and France serve as the primary logistics hubs for Russian Arctic gas. The tankers that keep Yamal operational are managed by British and Greek firms. The West is effectively financing the very shadow fleet it is trying to dismantle. This internal contradiction in the sanctions regime is the smoking gun that proves energy security will always trump geopolitical virtue signaling when the winter sets in. The $3 billion in ships sitting idle in South Korea are a relic of a financial era that is melting away. The power shift we are witnessing isn't just about who owns the tankers, it's about the death of the unipolar financial system. The question for 2026 is no longer if Russia can survive sanctions. The question is, can the Western financial system survive the loss of its monopoly over the world's most vital energy and mineral routes? As silver pushes toward $100 and the Northern Sea route becomes a commercial reality, the message to investors is clear. The era of paper wealth is being challenged by the era of physical reality. The Arctic is the front line, but your portfolio is the battlefield. If you are still holding 100% of your assets in a system that relies on the rules-based order, you are essentially a passenger on a ship headed straight for the ice. The ships are moving. The vault is open. The rules have been rewritten in the frozen waters of the North.
Forget everything you think you know about safe haven assets. While the world was distracted by the festive lights of December, a silent earthquake just leveled the foundation of the global financial system. Look at your screens. In New York, on the COMEX exchange, silver is trading at roughly $72 an ounce. It looks stable, it looks predictable. But turn your gaze east. In Shanghai, that same ounce of silver is screaming at $78. $6. That is not just a price difference, it is the sound of a system breaking. In the world of veteran hedge fund managers, a 50-cent gap is an opportunity, a $1 gap is a red alert, but a $6 gap? That is a financial declaration of war. This isn't just a glitch in the matrix, this is the moment the paper empire of the West hit a brick wall, literally made of physical Chinese silver. Tonight, we investigate the heist of the century, how Beijing just reclassified a common metal into a strategic weapon, trapped the Western shorts in a liquidity coffin, and why the silver in your hand might soon be worth more than the paper in your wallet. The spring is coiled, and if you're still holding paper silver, you're not an investor, you're a hostage. This is the death of price discovery as we know it, and the birth of a new, ruthless era of commodity warfare. To understand how we got here, we have to look at the ghost in the vaults. For decades, the West has controlled silver prices through the COMEX, a paper market where most trades are settled in cash, not metal. It's a game of musical chairs where there are 100 dancers but only 10 chairs. As long as the music plays, no one notices the shortage. But China just turned off the music. Beijing has officially reclassified silver under dual-use export control rules. On paper, it sounds like bureaucratic boredom. In reality, it's a kill switch. By labeling silver as strategic, meaning it has both civilian and military applications, China has ended the era of automatic exports. Starting January 1, 2026, if you want silver for your solar panels in California or your Tomahawk missiles in Virginia, you have to ask Beijing for a license. And guess what? Those licenses are subject to national security review. Normally, traders would buy cheap silver in New York and ship it to expensive Shanghai to pocket the $6 difference. That's called arbitrage. It's the glue that keeps global prices together. But the glue has dissolved. China is locking its doors. They are absorbing the world's physical supply and refusing to let it leave. The COMEX vaults are bleeding dry, with registered silver, the stuff actually available for delivery, dropping to historic lows. We are witnessing the first global physical squeeze, and the West is caught with its pockets empty. This isn't just a supply chain disruption. It is the systematic dismantling of Western financial leverage. Section A. The Ghost of 1934. Why is China doing this? To find the answer, follow the bloodline of history. In 1934, the U.S. passed the Silver Purchase Act, artificially driving up silver prices to save American miners. It accidentally, or perhaps intentionally, drained the lifeblood out of China's silver-backed economy, causing a deflationary collapse that paved the way for decades of chaos. Beijing has a very long memory. They learned a brutal lesson. If your economy depends on a material you do not control, your enemies will weaponize it against you. Today, the roles are reversed. China isn't just a buyer, they are the refiners of the world. They control 80 to 90% of the processing for rare earths and a massive share of silver refining. They have spent decades building the Gold Corridor and the Shanghai Gold Exchange to create a parallel universe where the US dollar is irrelevant. Section B. The Inelastic Trap. Here is the forensic analysis the mainstream media won't tell you. Silver is what economists call an inelastic asset. Over 70% of silver is a byproduct. It's the accidental metal found while digging for lead, zinc, or copper. If the price of silver triples tomorrow, a mining company can't just dig more silver. They have to build a whole new copper mine, a process that takes 10 years and billions of dollars. Supply is frozen, but demand? Demand is a raging fire that cannot be extinguished by high prices. Section C. The AI and green energy chokehold. We're told the future is green and intelligent, but the green revolution is built on silver. Solar panels? Silver. Electric vehicles? Silver. And then there's AI. Every H100 chip, every massive data center being built by NVIDIA, Google, and Microsoft requires silver for high-speed conductivity. Unlike gold, which sits in a vault looking pretty, silver is consumed. It's destroyed in the process of industrialization. China knows that by controlling the silver supply chain, they don't just control a commodity, they control the speed of Western progress. If they restrict silver, they can literally slow down the US's AI development while accelerating their own. Section D. The BRICS Gambit. This is the us versus them moment. The BRICS nations, led by the dragon, are moving toward hard assets. They are tired of IOUs printed by the Federal Reserve. By forcing a higher physical price in Shanghai, they're telling the world the paper price in New York is a lie. If you want the real thing, you pay our price in our currency on our terms. This is the weaponization of the supply chain to force a global de-dollarization. So where does this end? We are currently in the vacuum phase. The gap between paper and physical is widening into a canyon. Eventually, the vacuum will suck the life out of the COMEX. When the big industrial buyers, the Apples, the Teslas, the Raytheons, realize they can't get physical delivery from New York, they will panic buy at any price. That is when the spring snaps. We've seen this before. In 1980, silver went from $6 to $50. But back then, we didn't have AI, we didn't have solar grids, and we didn't have a multipolar world war for economic supremacy. This time, the ceiling isn't $50. In a world of infinite paper money and finite physical silver, the true value is a number that would make most economists lose their minds. They are watching the vault outflows. They are watching the Shanghai premium. China has broken the market, but in doing so, they have revealed the truth. The West has been trading promises, while the East has been hoarding reality. The question isn't whether silver will go up. The question is, when the paper empire finally collapses under the weight of its own lies, will you be holding a receipt, or will you be holding the metal? What do you think? Is China's export control the final nail in the coffin for the US dollar's dominance over commodities? Or is the West hiding an ace up its sleeve? Drop your thoughts in the comments, and don't forget to smash the like button to help this investigation reach the masses before the dual-use gates close for good. While the world was distracted by the festivities of late December 2025, something predatory was moving in the shadows of the global commodities market. While most investors were checking their holiday balance sheets, the silver market was being ripped apart by a 20% gain in a single week. Think about the sheer scale of that move. In a market that usually fights for pennies, silver jumped 10% in a single day, on a day when most banks weren't even officially open. But here is the paradox that should keep you awake at night. As the paper price on your screen touched a staggering $83 an ounce, the physical shops, the boots on the ground, were slamming their doors shut. Today, we are peeling back the curtain on the silver chaos of 2025. We're talking about a market where the institutional banksters have finally lost the remote control, where China is quietly choking the West's industrial supply, and where large-scale institutional capital is no longer asking for the price, they're just asking for the delivery. If you think this is just a retail pump and dump, you're missing the biggest geopolitical heist of the decade. This isn't just about coins, it's about the collapse of the paper illusion and the birth of a new, brutal reality in the US-China economic war.
Let's look at the forensic evidence of what just happened. Silver didn't just move, it teleported. We saw a weekly close at $68.97, which was already an elevated level, followed by an unprecedented surge. For a moment, late on a Sunday night when liquidity is thinnest, silver was trading in the $80. But the real story isn't the price on the screen, it's the chaos in the physical market. Reports from veteran dealers across the United States are painting a picture of a broken system. Shop owners who have been in the business for decades are reporting that despite being officially closed for the holidays, their phones haven't stopped ringing. The financial elite, the players with 5- and 6-figure orders, have officially woken up. What is most shocking is that these whales weren't buying when silver was at $30 or $40. They are buying aggressively now at $70 and $80. Why? Because they've realized that the spot price is becoming a lie. Last week, we saw an $11 drop in a matter of hours. To the uneducated observer, that's a crash. To the veteran fund manager, that's a liquidity grab. When the price hits an all-time high, massive institutions trigger a sell-off to hunt the stop losses of retail traders, only to scoop up the physical metal at a discount. The paper price says 72, but if you want to sell, they'll pay you 62. If you want to buy, you'll pay 80.
The middle ground has vanished. For years, the West treated silver as a decorative asset or a speculative play. China treats it as a strategic weapon. As the world's industrial juggernaut, China has been quietly limiting the export of silver throughout 2025. They need it for their solar dominance, their EV revolution, and their massive AI infrastructure build-out. By choking the supply, Beijing isn't just raising the price, they are effectively deindustrializing the United States. If American tech giants can't get silver, they can't build the future. We are seeing a net zero trap where the West's green energy goals are being held hostage by a metal they forgot to secure. China isn't just hoarding silver, they are weaponizing it. But last week, the iceberg orders hit the COMEX. Large entities, likely a combination of Eastern central banks and massive sovereign wealth funds, demanded physical delivery. They didn't want a digital receipt or a cash settlement. They wanted the bars in their vaults. When the short sellers tried to cover, there was no metal to be found. That 20% spike was the sound of the paper manipulation machine grinding its gears and exploding under the weight of real-world demand. The corporate Hunger Games. We are now entering a phase where retail investors are competing with corporate giants like Tesla, Apple, and Samsung. These corporations have realized that silver is the new oil. Do you think a trillion-dollar company cares if silver is $70 or $90 when they need it to keep a multi-billion-dollar production line running? They will pay whatever it takes to secure their supply chain. This creates a liquidity squeeze, where the average person is simply priced out or blocked from buying because the big players have already cleared out the inventory. Is this $11 correction the end of the run? Hardly. In the world of high-stakes trading, this is what we call a shakeout. The volatility is designed to scare the weak hands, the retail investors who bought at the peak and don't have the stomach for a 10% dip. But look at the underlying metrics. Even after the drop, silver is still sitting above $70. 1 week ago, that was considered an impossible dream. The market is establishing a new floor. We are also seeing a massive decoupling. The price you see on major exchanges is becoming disconnected from the reality of the refinery. When refiners refuse to pay near spot, it means they are overwhelmed by sell orders from panicked retail, but they are also struggling to source pure metal for their industrial clients. This chaos is the labor pains of a new financial system where hard assets, not digital promises, dictate power. The US-China battle over silver is the ultimate proxy war. If the US cannot break China's grip on the physical supply, the Green Revolution will be made in China exclusively. This is why the volatility is so violent. We are watching the price of a strategic military and industrial asset being revalued in real time. So, what is the endgame for the silver chaos of 2025? The events of this past week have proven that the silver market is a coiled spring that has finally snapped. The $11 correction isn't a sign of weakness, it's the market searching for a new, much higher equilibrium. The big banks are retreating to their secondary lines of defense, and they will use every media outlet at their disposal to tell you that the silver squeeze is over. But ask yourself, if it's over, why is China still hoarding? If it's over, Daisao, the financial elite, are buying the dip at $70. And if it's over, why are physical premiums behaving like a fever dream? The truth is, we are entering the period of true price discovery. We haven't seen the real value of silver in over half a century because of the paper chains. Those chains are broken. We are moving toward a world of unobtainium, where having the metal in your hand is the only thing that matters. Don't let the flash red on your screen blind you to the shining white reality. The dollar is fading, the East is rising, and silver is the lightning rod for the entire transition. The final question remains, when the dust settles and the market realizes that there isn't enough physical silver to satisfy even 10% of the standing buy orders, where do you think the price will stop? Leave a comment below.